Welcome to the recession times. I want to start off with showing you the financial statements of DRG Dry Cleaning. This past year, 2022, DRG Dry Cleaning had about $5 million in sales, $9 million in expenses, and a loss of 4.1, almost $4.2 million. Now, if we take a look at last year, it was a loss of $3 million, and the previous year, $3.8 million. Not looking so good, is it? Well, on top of the profit and loss statement, let's just take a quick look at the balance sheet. And they have current assets of $2.6 million with $800,000, almost $900,000 in cash. But here's the problem. Current liabilities, almost $9 million, and long-term loans, 28 million in change. And what does that mean? That means $39 million in total liabilities, total debt, a very large negative equity section. And you don't have to necessarily know these ratios, but the current ratio, working capital, debt to assets, debt to equity, these are all terrible ratios. They're going in the wrong direction year over year. No bank would ever lend to this company. And really the question is, how is this company still in existence? Well, let me show you the team here. So the team, we have the owner of DRG Dry Cleaning, Sam McManus, and when he needs money, he just goes and asks his uncle, his rich uncle, John McManus. Whenever he needs money, John is there because, like I said, no bank will lend to him. And where is John getting this money that he's so willing to offer more? Well, he's getting it from the Mexican cartel because DRG Dry Cleaning is a laundry. Get it? DRG, drug, dry cleaning. Now, obviously, this isn't a real company. However, this is very similar to a country that you're very familiar with. If we add 6 zeros to every one of those numbers that you just saw, we'd be looking at the current financial statements of the United States of America. So Sam is very similar to the United States of America, having one large deficit after the other and accumulating all of this debt. John McManus, the rich uncle who's willing to offer more money when needed, is very similar right now to the Federal Reserve in how they're handling the situation. And the Mexican cartel, the ones who are essentially creating the money from selling drugs, in this case, it's the U.S. Treasury, who is more than willing to print the money upon request by the Fed. So why isn't this a big deal? Why isn't this a big deal when, if we take a look at the current national debt, $31.7 trillion. Look at this, and growing fast, ladies and gentlemen. It's incredible. In fact, by the time I finish this sentence, we have increased our interest on that debt by $1 million. Every 40 seconds, the interest is increasing $1 million every hour, $90 million every day, $2.1 billion every year, $786 billion, $786 billion of additional interest on our current debt. And that's assuming we have no more deficits. And we already know we're going to continue to have deficits. In fact, in 2023, we're already $1 trillion in deficit. So it continues. Now, here's only to make matters worse, just to kind of, I'm taking the 6 zeros off just to kind of simplify this so that you can understand where we are as a country at the moment. But let's go back to this $5 million revenue number, because this is really 5 trillion is what the government receives in tax receipts and so on. But I'm lopping off the 6 zeros. It's the equivalent of 4.9, almost $5 million. 1.5 million is going to Medicare. 1.2 million is going to Social Security. 779,000 is going to Defense and War. And 538,000 is going to interest on debt, which is going to rise dramatically because our interest rates have risen so much. But even with this, we add that up, that's $4.1 million on legacy expenses. This is all the money that has to be spent. All that's left of this year's revenue is $811,000 to go against our operating expenses. We haven't even talked about our day-to-day operating expenses. So we're having this huge loss because of it. That's what we're dealing with right now as a country. And these legacy expenses are going to continue to grow as the baby boomers get older. So this is going to become more problematic, and that's going to be an issue for years, decades to come. All of our future generations are going to certainly struggle with this if we don't do anything about it soon. Now, why is this a problem? Why is nobody really making a big deal about this? Again, it's because we're talking about $1 trillion. It's so hard to get your arms around $1 trillion. That's 12 zeros. If we were to take $1 trillion bills and line them up, we'd have 3 football fields long, a 767, Boeing 767 wide, and 5 feet high of $1 bills. That's $1 trillion. It's an incredible amount of money. And that's part of the reason why people struggle with this concept, and that we're not really talking about this as a country yet. But eventually this is going to come back to roost, and we will be talking about it. And unfortunately, it's the longer we wait, the harder it is to clean this up the proper way. Now, last week, Warren Buffett had his stockholders meeting, and somebody asked, young girl actually asked about this situation. And he said, nobody knows how far you can go with a paper currency before it gets out of control, particularly if you are the world's reserve currency. So basically he was saying, hey, I can't, who knows? This could go on for a long time. And it's very true that the country is not a company. A company would have gone out of business a long time ago, but the country is different because the country can print money. So this could go on for years, decades. It's possible we could see this added deficit, added debt, increased debt every year for years to come, and still not have any problems. I guess we'll find out. But unfortunately, when we do, it's going to go bad really fast. So let's talk about the Fed, the Federal Reserve, also known as the Fed. Who are they? They're the bank for the banks of America. When the banks need to borrow money, they're going to the Fed, the Federal Reserve. And what's the Federal Reserve's mission? It's to keep employment high and inflation low by manipulating the U.S. market. So their mission, keep employment high and inflation low. And notice what's not in that mission. There's nothing that says avoiding a recession. So they will, if they feel they need to continue to achieve their mission of keeping employment high and inflation low, they will make the adjustments to the interest rates, even if it's risking a recession. Now, they're not trying to create a recession, but they would risk that if they need to in order to keep employment high and inflation low. Now, the Fed's U.S. economy manipulating superpowers, they have 3. The first one is called the reserve requirement. And what that is the amount of funds a bank must have on hand each night. So it's a percentage of the bank's deposits. Now, we're learning a lot about banks' deposits in current times here with the bank failures. And so the way the reserve requirement works is simply this. It creates a velocity of money. So if a bank were told by the Fed, you have to have 30% of all of your deposits, all of your customer deposits have to be in your bank every night. Then what a bank can do, because they're in the business of making money, is that they can lend out that other 70%. And if the reserve requirement is 30, what that means is they can lend out the rest of the money, and the velocity of that money ends up being about 3.25 times the money that they have in the bank. So there's an advantage to have a lower reserve requirement. Now, if the reserve requirement were 20%, again, the banks have to keep 20% of all deposits in the bank, then that would create basically a 5 times velocity for the banks. They can make more money. And if it were 10%, then the banks can make 9 times the velocity, which means they can make even more money. So the current reserve requirement right now is 0. Typically, the reserve requirement doesn't get over 10%, but it's been 0 for a very long time since COVID. And this certainly created some problems with the current banking crisis. Now, in all fairness, there's no bank in America. They're in the business of lending the money that comes in the door. So there's no bank in America, if there were a bank run, that they would have enough deposits. However, there are banks that had taken on considerable risk and made it certainly harder when there was a bank run or something close to a bank run. And we're still seeing the after effects of that, and it will continue. So the reserve requirement is no longer a superpower. Since it's 0, there's nothing more that the Fed can do there. Now, the Fed funds rate is the second superpower, and it is the interest rate banks charge each other to lend Federal Reserve funds overnight. This is the Fed. When you ever hear about the Federal Reserve increasing or decreasing the interest rate, it's the Fed funds rate that they're talking about. That's their second superpower. Now, right now, the Fed funds rate is at 4.83%. And as you can see by this steep uptrend, the Fed did something that has never been done since the beginning of the Federal Reserve back in, I believe, 1913. They've increased basically 5 percentage points in about a year's time. Never been done before. This is part of the reason why the banking system is breaking. But they need this. They need to increase the interest rate. The reason why the Fed did this is because this is a very powerful superpower to help get out of recessions. The gray areas that you see in the past here are recessions. And as you can see, the interest rate is always higher at the beginning of a recession and always lower at the end of a recession. Now, why is that? It is because the Fed decreases an interest rate and keeps decreasing until we get out of a recession. So when the Fed starts feeling like, hey, there's a recession, or they know there's a recession, they're going to start dropping the rates. The only way they can start dropping the rates is if they have rates to drop. And typically from history, usually 4 to 5 percentage points are needed to drop in order to get out of a recession. So this is why I believe they rushed to get to at least that 5%. And I don't think it's completely over yet. We'll talk about that in a little bit. The final Fed superpower, open market operations. What does that mean? That's when the Federal Reserve buys or sells securities from its member banks. And basically what we're talking about here is quantitative easing, printing money. Most of the time, it's about creating money and then buying bonds or other financial assets from the banks. Now, quantitative easing has a opposite side to it called quantitative tightening. And that's when the Fed is selling bonds or other financial assets and then destroying the money. In in a perfect world, that's what they were trying to do from the beginning. They started doing significant quantitative easing or printing money back in the early 2000s with the idea that they would have quantitative tightening and they would undo all of that quantitative easing. But what they learned is that every time they tried to tighten the money supply, or basically take all that money back that they printed and then destroy it, the economy starts falling apart. So they can't really quantitative tighten. Even recently, here's a good example of all of the quantitative easing, the printing that they've done, and the growth of the total assets of the Federal Reserve, now at around, $8 and change trillion. This is from all that added quantitative easing printing. Now, this little blip you see right here where we are currently, I'm going to show you that a little bit closer. Things start falling apart when they do quantitative tightening. And all they did here was go from basically 8.9 trillion and they dropped it to approximately 8.5. And this did a considerable amount of damage in the economy. We're not even talking about a lot of money here, but that's all it takes. Now, the problem with all of this money printing that they can't destroy is what we end up with is a drop in purchasing power. And what I mean by that is that when the Fed continues to print money, print and print and print, then there's more dollars chasing less goods. And over time, that has an effect on our purchasing power. So if we go back to 1913, $1,000 back in 1913 is worth approximately $33 today. So I guess the best way to think about it is this, is if $33, what does $33 get you today? Perhaps you go and get a lunch at a restaurant today, and what can you get for $1,000 today? You can get maybe a Chromebook and a TV or something like that. That's the difference of the purchasing power. It's dropped so much that $1,000 today that could get you a computer and a TV and you'd still have some change, eventually, because of all this printing, is going to end up being valued at just about a lunch. That's basically what has happened with our purchasing power since 1913. And it's continuing to get worse, unfortunately, because we keep printing. Here's the M2 money supply. So before COVID, there was $15.4 trillion, 15.4 trillion US dollars circulating this earth. And currently, we have about $22 trillion out there. So 43% more US dollars were created between March 2020 to March 2022. Think about that. In 2 years' time, we increased the number of US dollars circulating this earth by 43%. Now, you don't have to be an economist to know that this will create inflation. It certainly did create inflation. It's quantitative easing on steroids, and it creates extreme asset bubbles. And we saw it everywhere. We saw that same hockey stick effect, used car sales, house sales, producer price index, food, you name it, labor costs, Dow Jones, every asset you can think of is because of money printing. And this, of course, and the low interest rate, you combine that, it's just a lot of easy money. And people are spending it not that wisely. All right, let's talk about the U.S. Treasury. Who are they? They're the accounting department for the United States of America. Basically, they print, they mint, they pay the bills, they collect the taxes. They're the accounting department. Now, who do they answer to? They answer to Congress. They answer to the President of the United States. And in some cases, they answer to the Federal Reserve. Now, what is the Treasury? What do they have to do? They're the ones that have to fill the gap. Every year when we have a deficit, they're the ones that have to find a way to borrow the money to fill that budget gap. That's now up to $31.8 trillion, as you saw earlier. So how do they do that? Well, they offer Treasury bills, notes, bonds, and the maturity dates are anywhere between 1 month and 30 years. So basically what they're doing is saying, if you lend me some money today, I will give it back to you at that period of time, and I will give you X amount of interest to go with it. And that, ladies and gentlemen, is how we've been filling the deficit of our budget over all these years. And it's worked. But here's what's happening is just everything's moving faster. So from the inception of our country, 220 years. So from the inception of our country, 1776 to 1996, 220 years, we built up a debt of $5 trillion. Now, the 9 months of COVID, during the months of March 2020 and December 2020, we increased our debt by $5 trillion. So what took us 220 years took us 9 months to repeat. Now that's certainly problematic. Now our debt continues to rise, but it really took off after August 15th, 1971. And the reason for that was that President Nixon decided to take the U.S. currency off of the gold standard on August 15th, 1971. So if you were to look at your money before anything that's dated before that date in 1971, what you'll read on each dollar, whichever denomination, is that it's redeemable in gold on demand at the United States Treasury. So you could essentially go to a bank and ask for the equivalent of that money in gold. And after we got off of the gold standard, this is what our dollars read now. This note is legal tender for all debts, public and private. So now everything's based on trust. There's no gold standard. There's no other standard. It is just based on the trust that the $5 that you see here is going to still be worth $5 tomorrow and the next day. One of the things that the Nixon administration did that was very smart is that after they got off the gold standard, they made a deal with the Saudis, and eventually it was called the petrodollar. And basically the deal they made was that if the Saudis agreed to price all of their oil sales in US dollars, and the Saudis would invest their surplus oil proceeds in US debt instruments, then the US would provide arms and a security guarantee to Saudi Arabia. It'd basically protect their oil fields from anybody, any other countries and terrorists or whatever. And that worked out great for the United States, especially because now they had a agreement where in order to purchase oil, which was the largest commodity worldwide, in order to purchase oil from the country that exported the most at the time, it would have to be transacted in US dollars. And any additional surplus, the Saudis would use to purchase our US debt securities, which would supplement any of our deficits from year to year. So this is a great opportunity for the United States. And this ultimately became the reason the US dollar was the reserve currency for the world. Because if you think about it, the reserve currency for the world is a currency that is used to trade commodities around the world. And the US dollar, by almost default after oil, became that currency. So that's been going very well for the United States. Now, when the Treasury lends money, a typical yield curve looks like this, where you get less interest when you're lending money to the government, for a shorter term note or bond. And then you get more interest for longer term because, I mean, if you think about it logically, if you're lending your money for a shorter period of time, there's less risk because there will be less variables. If you lend your money for a longer period of time, well, there's a whole lot of variables that could go on and you deserve more interest for that. Now, this is a normal curve during normal economic times. Now, what we're seeing is the opposite of that currently. It's called an inverse yield curve, where right now, this blue line, this is current. This blue line is showing that I could get 5% with a 3-month note, or I could get 3.5% if I lend my money for 30 years. It almost doesn't make sense, but this inverse yield curve is a very important sign to an upcoming recession. And as this chart shows, and this is the difference between a 2-year and a 10-year treasury. When the 2-year is higher than the 10-year, then this blue line ends up going below this 0%. And what we're seeing here is every time that has happened for the past 7 recessions, it has been the leading indicator for a recession coming. And as you can see here, we are going deep now into the negative, and there's a greater risk than ever that a recession is coming. Okay, so let's talk a little bit about a recession. How do we define a recession? Well, for the longest time, a recession was defined as a decline in gross domestic product for 2 straight quarters. Now, GDP, what does that mean? That's total value of goods produced and services provided in a country during 1 year. So if I were to bring this down into small business talk here, it's the same thing as saying that if your sales for the first quarter were 984,000, and for the last quarter, fourth quarter of the previous year was 1 million, and you had a difference of a negative 16,000, you'd have a negative 1.6 or a negative quarter. So that's what we're comparing when we're comparing quarter over quarter GDP. And if there's 2 of these in a row, then that's considered a recession for the United States of America. Now, we saw that in 2020. This was during COVID. So this was, one of those debatable situations. And then we saw it again, 2 very small negative quarters at the beginning of 2022. And this was the point where the government was debating whether or not this was truly a recession. They were debating if, they were saying that basically that negative GDP, two quarters negative GDP, was not necessarily how they define a recession. And maybe they were right, because afterwards we had 3 positive quarters. We have had 3 positive quarters since. But then the question is, how do you define a recession, and what do you do about it? So how do I define a recession? I guess I'm looking at a considerable amount of data. Right now, credit card interest is at 24.1%, used cars 13.7%, new cars 8.7%, mortgages 7.1%, and total debt by category, we have credit cards that have now topped 1 trillion, auto loans, mortgages, all of these are at a record high or high, very high range debt amounts. And I guess the question is, are these recessionary numbers? I look at this and I look at other data points and I ask myself, are we in a recession right now? I mean, if we take a look at the commercial mortgage maturities, $500 billion for the next 5 years are going to mature. Commercial mortgages are going to mature in the next 5 years. So that's $2.5 trillion over the next 5 years. And the problem with that is that all of those were in a prime rate when they originally had these loans of the low 3%. Now we're at 8%. This is going to make it very difficult for some of these building owners to be viable. So there's a huge risk with these commercial building owners right now. U.S. metro office space vacancy is now at record highs for the country. And that's certainly another recessionary data point. And then the banks that are holding the most commercial real estate loans are regional banks. 80% of the banks with assets and commercial real estate loans are regional banks. So this is certainly problematic too, and that is potentially recessionary as well. Some of the other data points that tell me that a recession is coming: U.S. temporary help services, temps, tend to be the first that are let go in a company. And as you can see, the last time we had some significant drops were right before recessions. And we're going to see it again, I believe. We're seeing it right now, and I assume that's preceding a recession. The U.S. probability recession based on yield curve 2-year to 10-year within 12 months is now at like a record high of 73%. So another data point that says we're probably going to go into a recession, considering the last 3 times that it was even over 40, we hit that. The U.S. tech versus S&P 500, every time it would hit this blue line, we would hit a major recession. So this happened in the 70s. This happened in 99, and it's happening right now. So another data point that says maybe we're going to be seeing a recession soon. And then lastly, and this is certainly problematic, because of all the low interest, because of all the free money and the cheap money, we now have 20% of all our companies are in zombie territory. They're zombie companies, and that's defined by companies that are making less profit than the cost of the debt that they're paying each year. So 20% of the companies out there have a higher debt cost than they do the profits that they're making. And certainly going to be a problematic situation, because if we get into a recession and all of a sudden revenue drops, these companies will not be able to survive. Now, the length of recession, when it does come, tends to happen every 6 years and last for about 1.5 years. So, ladies and gentlemen, the recession is inevitable. It's going to happen. And you need to accept it. It's actually a healthy part of the economic cycle. We need a recession. It does wash out some of the businesses that shouldn't be there in the first place. It's really not the question you should be concerned with, though. So you shouldn't be asking yourself, when is the next recession? Like I said, it's going to happen. We will always have another recession coming. The question you need to be asking yourself is really, is my company recession-proof? That's it. That's what's in your control. And the way I define it is my business capable of surviving 30% drop in sales for at least 18 months? And the reason why I'm using 18 months is that's the average time a recession lasts. So 30% drop in sales over 18-month period. And the answer should be yes. And it can be yes. There's no reason why you can't forecast that. You can't prepare for that. There's no reason why that can't happen. Now, what do you got to do? You got to focus on what's in your control. First of all, forecast the P&L using that 30% drop in sales scenario. Now, I teach this for a living. It's a very simple spreadsheet where we could just plug in all your financial information and then do scenario analysis where we drop your sales by 30%, by whatever, 40%, 20%, you name it, and then just see how it affects your overall P&L and what adjustments that you need to make. Now, if you are watching this and you are interested in this spreadsheet, I will be more than happy to share this with you. It's a very simple Excel spreadsheet, Google Sheet spreadsheet, got it for both. And if you want it, I'll be happy to give it to you. I'll be happy to do a video on it. In fact, if you like this video, please like this video, but leave a comment if you're interested in this spreadsheet. I'll be glad to give it to you. The second thing is to build a strong balance sheet. I teach for a living as an adjunct professor how to read your financial statements to small business owners. And there's 6 ratios that we always learn. These are the 6 ratios that you're looking at here. And if you understand these ratios, you know how to calculate them. And if you understand what they mean, you can understand the health of any company anywhere in the world, because they're all built the same, the balance sheet and the profit and loss. So you can learn a lot about them with just simple 6 ratios. However, a real quick and dirty way to determine if you have a healthy balance sheet, simply this: if your asset value is twice the value of liabilities, you got a pretty strong balance sheet. If your assets are equal to the value of your liabilities, then you could be at risk if there's a significant drop off in your sales. And if your assets are less than your liabilities, well, you're in a danger zone, because if a recession hits, then you could be in serious trouble. The next thing is understand your gross margin. With the increase in costs that we're seeing, the increase in labor costs as well, material costs, all of that is really dramatically hurting every company's gross margin. And if you do not know how to measure your gross margin, if you're not tracking it, if you're not breaking it down by products, then you're at risk, because you may not realize that you're losing your gross margin. And when you lose your gross margin, you lose your net profit, period. You always want to maximize labor efficiency. Labor is one of the biggest expenses in everybody's income statement. I've looked at thousands of profit and loss, which is also known as an income statement, thousands of profit and loss statements, and the cost of labor is always in the top 3 of expenses if it's not 1 and 2. You got to maximize labor efficiency. And unfortunately, part of the reason why we got to do it is because we're going to be struggling to find labor for many years to come. As you can see, it's harder than ever to find workers, to find employees. That hasn't changed. Before COVID, the baby boomers' total asset value, if you took all the baby boomers, added all their assets together, they were worth $65.3 trillion before COVID. During COVID, their asset value increased another $1.2 trillion. So while that was happening, a lot of these baby boomers feeling really rich, feeling pretty good about their retirement, and said, you know what, I'm out. And by the third quarter of 2020, number of baby boomers that were fully retired was 28.6 million. And to just give you an idea what 28.6 million is, that's 8.6% of our total U.S. population, 11% of our adult population, and 22% of our full-time employed. That's a lot of people. And as you're going to see, they're going to continue to resign. in just record numbers. Next five or so years, we're going to see around 1.7 to 2 million baby boomers retire every year. There is going to be a labor shortage for a while because it is hard for the rest of the generations to fill that gap, considering the baby boomers are such a large generation. And on top of that, average weekly earnings have gone up about 4.2% from a year earlier. But unfortunately, because of the cost of inflation, people feel like they've actually lost money, 4.4%. So that unfortunately makes even more pressure for employers with increasing labor rate. And you're going to continue to see that, unfortunately. Savings rates have fallen to record lows. So people have spent all that free money. Credit card bills are now, if you add them all up, they're at about $1 trillion. This is a record high for the United States. So now they're building up. They have no more savings. They're building up all their credit card debt, which has forced people back into the labor market. Men and women are now coming back to work because they have to. So that might help solve some of our labor problems, but they're not going to go away. You have to be as efficient as possible with who you have. You also have to reassess your safety storage and your inventory because the good old days of just in time are over. Globalization as we know it is over. This is a picture, a GPS picture of all of the boats, all the ships, container ships that were in and around the ports of China when they shut down the cities. This created a major glut in our supply chain, and we still haven't gotten out of that. But just-in-time management is over. It is now something much less than that. And it's caused our shipping rates, if you recall back in the COVID days, to go up to almost $20,000 to ship a container from China to the United States. And now look at it. It's at a record low of $1,000, which, by the way, is another leading indicator that things are slowing down out there. So you want to be very mindful of the inventory that you hold, of how you're holding your supplies, your safety storage, because it is a very tricky time. And as much as it feels like maybe you should have more inventory, it may not be the right thing to do. There's been many companies that have had to sell at a major discount because they thought they needed more inventory, and they end up having the wrong inventory, and then people aren't buying what they thought they would. And then finally, utilize AI, such as ChatGPT. This is going to disrupt every industry. If you do not understand the power of what ChatGPT and Bard and other AI can do, then you are falling behind, because this is not a fad. This is going to disrupt every industry. And I do have a video on ChatGPT. If you're interested in watching that, you can see that on my YouTube channel. Okay. Recession predictions. I always like to have predictions. Sometimes I'm right. I believe the Federal Reserve will increase interest rates another 25 basis points in June 2023 and begin dropping by the end of the year. So here's the good news. The increases are almost over. Another 25 basis points, I believe, in June, and then that's it. And I also believe they're going to be dropping by the end of the year. But if the fact that they're dropping is certainly a sign that we're in a recession if they start dropping. So be mindful of that. Manufacturing and trades will make a strong comeback in the United States now that we can't rely as much on China and other countries. We want to bring it closer to home. And certainly we're going to see that in the Western New York region as well. And it's going to outpace university demand. So basically all these years, all these decades where kids leaving college didn't want to go into a trade because it just seemed like it wasn't as good as a university. Well, that narrative is flipping because trades are paying incredibly well, and you don't have to go to school for a very long time in order to get paid a pretty good amount of money. Inflation will settle down between 4 and 5% in 2023. It's already almost there. I think it's going to remain there for a while. I do expect it will rise again, but that's maybe in 2025. But for now, 4 to 5%. We will begin to see 50-year mortgages and record defaults in car payments. We're going to just be extending out some of this debt. That's one of the ways to unfortunately deal with more debt, is to extend it out further. Not the best option, but expect to see 50-year mortgages, considering these houses are beginning to increase in price just way too fast. I mean, they're significantly higher, again, partly because of all that money printing and the asset bubbles. A 30-year mortgage is, topping that 7%. And if we compare a 30-year mortgage back in January 2021 with a 30-year mortgage around today, assuming a 20% down payment, there's a 123% increase in monthly payment from $1,294 back in January 2021 to about $2,800 today, when we're talking about the average interest mortgage rate and the average cost of a house. That's significant. I mean, 123%, most people can't afford that. And then if we go to new car borrowers, notice what we have here. Share of new car borrowers that with monthly loan payments of $1,000 or more. Look at this. It is growing incredibly fast, over 12.5%, 12.7% of buyers in February had a monthly payment of at least $1,000. And the average lease payment for cars is now $730, new and used. It's crazy. This is crazy. How does this end well? I don't know how everybody can afford this. I believe the S&P is going to drop another 20% to around 3,300 by November of 2023. And here's why. This past performance doesn't guarantee future results, but I believe this is an overlay of the black line here is 1999, the dot-com bubble, and the red and green is current. And as you can see, it is tracking this time frame very well. And I expect that we're going to see this drop off somewhere later in the year, just like we did in 1999. Now, that's just my opinion. This is not financial advice. Continued breakdown of the petrodollar and the U.S. Reserve world currency. Now, just so you know, the reserve world currency, about 83% of all transactions of commodities happen with U.S. dollars. So that's significant. It would take a long time for us to no longer be the reserve currency of the world. However, companies like the BRICS, Brazil, Russia, India, China, South Africa, they've created this group. These are commodity-based companies that are working together, and they've been doing this for quite a while now, but they're working even more so together to create a commodity-based currency where they're trading with each other in their own currencies, or possibly create a currency that is commodity-based and backed by whatever country's commodity happens to be their dominant commodity. And now they're seeing momentum because a lot of these other countries don't want to be relying on the US dollar. So now they have a membership bid of 19 nations on top of the ones that already are part of BRICS. And that includes countries like Saudi Arabia and Mexico. So this is certainly going to be become more of a force as time goes on. Right now, not as big of a deal, but we're going to start seeing that breakdown. I believe there will be more regional bank failures. The overall cap valuation of regional banks a year ago was about $400 billion, and now it's $100 billion. Banks use the value of their stock as a way to borrow money from the market. And if all of the value has dropped this much, it's virtually impossible for them to borrow money. And it certainly makes them greater risk for a bank run. And as you can see, just this year alone, 2023, we've had a significant amount of bank failures. And adjusted for inflation, it's essentially the same as 2008, when that was considered the worst. We're not done yet. I believe we're going to see some more. The debt ceiling is not going to be a problem. There will be no debt ceiling default. If we default as a country, what that means is that the money that we're borrowing, we're saying that we're not good for it, that we are not going to pay back the people that are lending us the money. If we do that, then no country out there is going to buy our bonds, and there's no way that we'll be able to fill that budget gap. We have too much at risk. And as you can see in the past here, this black line, every time we have this stair step, every time we hit a debt ceiling, we increase it 28 times. And the red and blue line, red line, that's when it was a Republican, and the blue, that's when it was a Democratic president. It doesn't matter who's in office. It doesn't matter. The debt ceiling will increase. Nothing to worry about. It's political theater. That's it. Now, as you have seen, you could probably guess that I believe a recession is coming. It's going to happen the third quarter of 2023. But good news for all of you that are in Western New York, you will be spared. We are building a brand new $3 billion stadium for the Buffalo Bills, and that is going to insulate this region because we're going to be bringing hundreds of people in from all over to help build this thing. We are going to be insulated from a recession, so that will be the good news. So if you're ready, if you have a strong balance sheet, if you're prepared, you want a recession to happen because there are going to be incredible opportunities that will be available for you and for your business. And it is a healthy part of the economic cycle. So just be prepared. That's all you have to do. That is the recession times, my friends. I hope you enjoyed it. If you did, please like this. Please share this. And there'll be many more to come. You take care. Have a great